Well, good afternoon. Thank you, Bill, for that kind introduction. And thank you very much for the invitation to speak to the Edmonton Chamber of Commerce. In fact, when I decided to accept this invitation, it took me all of about 10 seconds to decide on the topic of my speech. Because the impact of lower commodity prices on the Canadian economy is really important to all of us. And you, as business leaders here in Alberta, well, you know this better than most because you're living and you're experiencing it every single day. Now, at the bank, we have committed a serious number of resources to this topic. And so I thought it would be helpful to share some insights from a macro perspective as to how we are analyzing the adjustments that we're currently facing. Oil prices alone are down by more than 60% from the peaks that we saw in 2014. And given the supply dynamics that we're currently faced with, it is highly unlikely that we will see those types of price levels in the coming years. Now, while this price drop is affecting all Canadians, it is being felt most acutely here in Alberta and in other oil-producing regions across the country. We at the bank are well aware of the toll that this is taking on firms and the hardship that it means for families and for individuals. Yet the message that I want to share with you today is that Canada's economy remains diverse and dynamic enough to achieve, in time, a new balance of economic growth. Allow me a few words in French. Aujourd'hui, je veux vous dire que l'économie canadienne est assez diversifiée et dynamique. Ainsi, à terme, la croissance pourra reposer sur un nouvel équilibre économique. While energy and other commodities will continue to play a very important role in our economy, it is highly unlikely that they will account for as large a role in our exports as they have in the recent past. So let me turn to a few questions that are top of mind for us at the bank and most likely of interest to some of you. The first is, how do we assess a shock like this? And the second is, how does the economy adapt? And how long will this adaptation take? And lastly, what will the economic landscape look like when it's finished? So before I answer these questions, let me provide a little bit of context. In the early 2000s, a broad-based boom in commodity prices began, and it was fueled by growing demand in emerging market economies. Canada was a big beneficiary of these rising prices. Our terms of trade, which is the price of our exports relative to our imports, improved dramatically. And so did our real domestic income. And this is a measure of the purchasing power of income that we generate here in Canada. Rising commodity prices also boosted economic activity and particularly business investment, which generated jobs in the natural resource sector. As commodity prices and Canada's terms of trade improved, the Canadian dollar appreciated. From a low of about 62 US cents in 2002, the dollar rose to around parity between 2010 and 2013. Now, in this environment, Canada's flexible exchange rate helped the economy from overheating. As the dollar was appreciating, it actually acted as a headwind for some industries in the non-commodity sectors. This, in turn, reinforced those incentives for capital and labor to shift to commodity-producing regions and sectors. Indeed, workers migrated in large numbers to regions of the country that were benefiting from job creation in the resource sector. The oil boom in Alberta actually provides the strongest example of this. Between 2002 and 2013, more than 250 million people more than 250,000 people, that would be a lot of people, more than 250,000 people moved here from other provinces. We also saw the number of workers that were commuting to Alberta double during this period, rising to about 8% of your provincial workforce. I'm sure many of you felt the benefits of higher commodity prices. You likely witnessed changes in your city and in your neighborhoods. But by late 2014, you may also have begun to feel a cold wind blowing. With a significant decline in commodity prices, the economy was faced with a material shock. So let me turn to my first question. How do we assess a shock like this? Well, at the bank, we use a variety of analytical tools and sources of economic intelligence to better understand shocks like this one. Some of our tools, such as the Business Outlook Survey, help us to identify near-term impacts like changes in business investment. And others help us look at a longer time horizon. The recent drop in oil prices merited particular attention, not only because of the size and the speed of the decline, but also because of the relative importance of oil production and investment. As oil prices began to fall, we closely monitored announcements of capital expenditures. We also analyzed the impact of past oil price shocks on investment, and we talked with firms in the energy sector to try to understand how they were responding to the price declines. And the picture that emerged was one of a sizable contraction in business investment in the oil and gas sector. And so in January of 2015, and again in July, concerned about the impact of lower oil prices and the risk to inflation, and to facilitate the economy's adjustment to its new circumstances, we lowered our policy rate. Now, for insights into the longer horizon, we ran a simulation of the shock in our workhorse model, which is called the Terms of Trade Economic Model, and we also refer to it as TOTEM. Now, TOTEM is designed to capture the impact of these terms of trade shocks, and it's fed all kinds of data, like information on consumer spending and household wealth, labor and wages, imports and exports, long and short-term interest rates, government spending, and business investment. This model helps us understand how these components interact in response to shocks. It also allows us to explore the linkages between the non-commodity sector and the commodity sector. And it also shows us how the exchange rate, as well as monetary policy, facilitate the adjustment to shocks. The TOTEM simulation provided us with insight as to how the fall in commodity prices would affect the broader economy. Now, the shock is really complicated because it sets in motion several seemingly non-synchronous forces. On the one hand, it told us that our resource sector would shrink and we would earn less income from the rest of the world. On the other hand, it told us that our non-resource sector would gradually begin to expand, and at the same time, the Canadian dollar would depreciate. Now, by convention, in these simulations, we assumed a commodity price that they would remain roughly where they were at that time. And so for this simulation, we used a West Texas intermediate price of $46 per barrel, so a little bit higher than where we currently are. But that was 60% below the peak that we saw in June of 2014. And so this simulation predicted that by the end of last year, the commodity price decline would cause GDP to be 1% lower than it otherwise would have been. And that's what happened. As investment fell, firms began to cut their workforces. You all likely have friends or neighbors or colleagues that were affected by these cuts. By December of last year, roughly 30,000 jobs were lost in the mining and oil and gas extraction sectors in Alberta, Saskatchewan, and Newfoundland and Labrador. That's a decline of almost 20% from the peaks in 2014. But the supply chain linkages and the spillovers into other sectors meant that the losses were actually much broader. Almost 70,000 jobs were lost across these provinces. Now, regional divergences also emerged. And while employment in energy-producing provinces fell, it grew in the rest of Canada. And as a result, unemployment rates rose in some provinces while remaining flat or declining in others. Now, the employment decline in the resource sector also had an outsized impact on our national aggregate earnings. Because not only do these jobs pay well, they also tend to call for longer working days and hence more hours worked. Our simulation suggests that this commodity price shock will cause aggregate earnings to be 2% lower by the middle of this year than they otherwise would have been. Now, this retrenchment in the commodity sector is the first and obviously the most visible step in the adjustment process. But over time, the losses in income and wealth associated with this price decline will spread across the country. As I mentioned earlier, our terms of trade improved substantially in that 10-year period before commodity prices began to fall. Well, at this point, we've given back about half of those gains. Measured at annual rates, this represents a loss of more than $60 billion in national income, or about $1,800 for every Canadian. Now, the drag on household spending is initially small, as it's pretty concentrated in the commodity sector, and the stimulus from the bank's interest rate cuts last year helped to support the broader economy. But the impact on real incomes is gradually building, and we do expect it to be the dominant source of drag on the economy by next year. As wealth and incomes decline, households will likely restrain their spending, and we will see lower but still positive levels of consumption growth. So now that I've given a few numbers around the impact of this shock, I'll turn to my second question. How long and what form will this adjustment take? Well, it's difficult for us to be precise about the timing and the underlying shifts of the economy. But our best guess is that this full adjustment will take longer than 2 years, which is our normal forecast horizon. With that said, we do have a few clues that are helping us to frame the timeline. First, in examining labor markets, we're seeing an interesting development that suggests that we may be adjusting to this economic shift more quickly than we have historically. In the past, regional shocks would have led to a persistent divergence in employment rates across provinces, and this divergence was much higher than the corresponding gap that you would see in the United States. But this gap in Canada has now shrunk to US levels, which is a little before 4%. And we explain this further in a staff analytical note that we're posting on our website today. Now, this is just one indicator of labor mobility, but the convergence suggests that Canadians have become more willing to move to where the jobs are. That may mean that regional labor markets will adjust more quickly to the decline in commodity prices. And in fact, we are already seeing some shifts in migration patterns. By the final quarter of last year, the flow of workers, of people moving to Alberta had reversed. And Ontario registered the largest inflow of interprovincial migration since 2002. In addition, the flow of workers who were commuting from their provinces to Alberta has fallen sharply. Now, a second clue is that there is a close but an imperfect link between our terms of trade and the value of our currency. And so it's no surprise that the value of the Canadian dollar has fallen along with commodity prices. Since late 2011, when some commodity prices first began slipping, the Canadian dollar has lost roughly a third of its value. Now, there's many factors that influence the exchange rate, but its depreciation, which will certainly hurt some businesses, is a necessary part of this adjustment process. The weaker dollar acts as a buffer for Canada's exporters. It offsets part of the drop in US dollar commodity prices, softening the blow to Canadian dollar revenues of commodity exporters. Similarly, the depreciation boosts the Canadian dollar revenues of non-commodity exporters that price their goods in US dollars. The weaker dollar also makes Canada's exports more competitive, and we're already seeing evidence of this. In particular, export categories that are sensitive to the exchange rate have performed better than average. Some of these categories include building materials and furniture, industrial machinery and equipment, and pharmaceuticals. Now, the service sector also benefits, and tourism is surging. The number of foreigners traveling to Canada jumped 11% in January compared to the same time period last year. Film and television production is also enjoying a revival across the entire country. As many of you likely know, The Revenant was shot here in Alberta. And in Vancouver last year, more than 350 productions were shot, which was an increase from 2014 of over 40%. Now, estimates from Totem and some of our other models suggest that it typically takes up to 2 years for the full effects of an exchange rate movement to be felt. And so since the loonie fell 15% in 2015, more gains are coming. And of course, the resource sector is not standing still. We expect to see new efficiencies, further innovation, and shifts in investment. For example, here in Alberta's industrial heartland, there are ongoing investments in upgrading and processing that will help diversify the mix of products from your natural resources. Now let me turn to the last question that I posed at the outset. What will the economic landscape look like when all these adjustments have worked their way through? Again, although we can't be precise about the timing, several years from now, we expect that the Canadian economy will have found a new balance. Our simulation predicts that the share of the commodity sector in the economy will decline toward its pre-boom level. By 2020, the sector could account for roughly 40% of our exports compared to 50% in 2014. Similarly, the sector's share of business investment could fall to 40% compared with 56% in 2014. Now, lower commodity prices will lower incomes and are likely to lower the economy's potential output. This is the result of a number of factors, but driven primarily by the drop in investment in the resource sector. It's also influenced by the rise in the price of imported capital, which will negatively affect investment in all industries. With less investment, the country's stock of capital will be smaller than it otherwise would have been, lowering the economy's productive capacity. Now, the extent to which potential GDP is permanently lower will depend on how much capacity is rebuilt in the non-commodity sector. As well, lower oil prices could spur companies to innovate and achieve greater efficiencies in their production cycle. So we're studying all of these questions right now, and we will update our estimate of potential output in the April Monetary Policy Report. So our modeling exercise laid out a plausible longer-term scenario for the economy, but it is subject to many assumptions, and I want to just touch on 3 very quickly. The first is the impact and whether or not we have accurately assessed the extent of decline in business investment. The second is the timing, both with respect to the pickup in non-commodity exports and the reallocation of labor. And lastly is the assumption that we used of flat oil prices. So let me just say a few words, because I'm here in Edmonton, about our oil price assumptions. In the near term, the risks to oil prices appear to be balanced. Elevated inventories still represent the main downside risk, but we now have a new upside risk in the form of a faster than expected decline in U.S. production. In contrast, over the medium term, the risks remain tilted to the upside. The significant reductions in oil investment since late 2014 could leave the future increases in global demand unmet. That would put upward pressure on prices and draw some investment back to the sector. Now, the level of prices that would balance the oil market in the medium term is still highly uncertain because we're seeing significant technical improvements and other efficiency gains by oil-producing firms, and this has lowered costs of production. Moreover, as we highlighted in our January monetary policy report, lower oil prices may make it more likely that adverse threshold effects on economic activity may occur. If prices were to fall to such a low level that firms struggle to cover their ongoing costs, consolidation could accelerate, and that would result in a more pronounced decline in production and weigh on the broader economy by hurting demand and confidence. So let me wrap up. Our simulation of the commodity price shock is just one example of how we assess the various factors that are influencing the Canadian economy. Examining this shock in isolation enhances our understanding of its potential influences on our outlook for inflation. We consider this type of analysis along with many other inputs when we set monetary policy. As we note in our monetary policy reports, we conduct a rich analysis around our projections and identify risks to the inflation outlook. This analysis acts as the foundation for Governing Council to assess and exercise its judgment on the appropriate stance for monetary policy. Earlier this month, we left our policy rate unchanged at 0.5%, since the economy was evolving broadly in line with the projections and expectations that we had set out in January, which is for roughly 1.5% in GDP growth for 2016 and 2.5% for 2017. In our April monetary policy report, we will update this forecast and take into account the fiscal measures that were announced last week. We are mindful that the changes to our economy that are underway are and have been difficult, particularly here in Alberta. Adjustments to large negative shocks take time. And although painful for many, the shifts are signs of a dynamic economy. C'est une chance que la richesse du Canada repose sur une grande diversité de ressources naturelles et humaines. Et un grand nombre de secteurs d'activité alimentent la croissance économique. Et tant que nation commerçante, nous devons laisser le processus d'ajustement suivre son cours aussi efficacement que possible. We are fortunate that Canada's wealth is based on a broad set of natural and human resources. The growth of our economy is powered by a wide range of industries. To make the most of our opportunities as a trading nation, we need to let the adjustment process unfold as effectively as possible. This won't be easy, and it will take time. The best contribution that the bank can make is to set policy that will help keep inflation low, stable, and predictable so that you and all Canadians can plan and invest with confidence. And as business and community leaders, you can help by being proactive and innovative in your respective fields. Thank you for listening.
Lynn, thank you so much. We really appreciate that. And as I mentioned earlier, we have a unique opportunity now to ask some questions of our Deputy Governor. So, note here, we've got a roving mic right behind you. There we go.
And just before you start, I'm going to do a little advertisement, but I just wanted to remind everyone that we are in the process of a public consultation to select an iconic Canadian woman to be on the first banknote of our next series. So this note will be issued in 2018, but you might see a little card that looks like this around your table. You still have a couple of weeks to nominate someone. I think it closes mid-April. So there's a lot more details on our website if you're interested. And now back to questions on the speech. Yes, thank you.
Ms. Patterson, you mentioned that the recovery from the commodity price shock is going to, take hold, you project, in 2 years. Is that 2 years from today or some other date? What I said is that it's going to take more than 2 years. 2 years is our typical projection horizon. And so some of the speech topic that I talked about today is based off of a paper that we published in January. And in that paper, that research paper, they looked at a 5-year time horizon between 2015 and 2020, and that's the reason why I cited 2020 for a couple of the statistics. And what that shows is that you basically have a 3-phase process to this adjustment to a large negative shock. And that first phase, looks like it should theoretically bottom out sometime this year. But it's really hard to be very precise about that. But it began through 2015. Clearly, we saw a significant drop in business investment, around 40% last year. Our current expectation is that we'll see business investment in the resource sector fall by another 20 to 25% in 2016, and then it starts to come back. Now, at the time that this is going, obviously, business investment in the non-resource sector is starting to pick up, but it's still the magnitude of the shock and the speed at which business investment collapsed, has caused it to have an overwhelming impact on Canada's GDP and certainly here in Alberta.
Other question? Back here? Oh, there's one over here. Okay, Nicole, we'll go to you first.
Thank you, Deputy. It was a great talk. I promised Bill if I got up I wouldn't be political, so I'm going to try and ask my question without being political. But we had a shock here too in Alberta about a year ago, and we had an election, and the outcome was a bit of a shock. I'm not saying it was a good shock or a bad shock, out of respect for our elected officials that are here. I know some of you were shocked as well too, even those of you that got elected. But anyway. So it was a shock I think in fairness it was a shock for everybody. But one of the impacts of that, I'd say for the last few decades, at least in Alberta, the Alberta Advantage had been such a driver of driving entrepreneurs and business owners and leaders to this province. And we saw on the weekend a bit of a retraction of that. We saw, Murray Edwards, one of a big wealth creator in this province, job creator, is now moving his residence to London, England. And I'm curious if your totem, your statistics, does it take into account if the billionaires and the millionaires and the people that, entrepreneurs in this province are starting to move out of here because of the shock of increased taxes is the assumption, at least the media assumption, of why Murray Edwards is now moving his residence to London. What is the additional shock this could be for Alberta if these sort of job creators continue to leave this province?
Well, I don't think it would be appropriate for me to speak about any particular individuals, but the model takes in a number of inputs, obviously from very much an aggregate perspective. So, I think though one of the notions that I tried to bring out at the beginning and again at the end is, the oil and gas industry and the commodity industry in Canada continues to be extremely important to us, even as we find that new balance. So, I'm sure there could be some young entrepreneurs sitting in this room that might be the next evolution of people that you've lost. So, or there could be someone in another part of the country. So I think, we recognize that we have to take on the shock. We can't impact the level of oil prices. We're seeing a tremendous amount of innovation and technological improvement go on in this space every day. And so I think, it's important for us to try to stay at pace with that in Canada, because, it's important for us to obviously have all the opportunities that we can with the natural resources that we have. So I'll leave it to that, and I won't make any comments on any of the political and fiscal changes.
Wise move. Wise move. Got a question over here.
Thank you, Deputy. In your presentation, you spoke somewhat about the interconnectivity of the economy to the wider global market. If you read the mainstream press, there seems to be a bit of a divergence between the monetary policy responses of the ECB, of the Feds down south, and our own central bank. Can you maybe elaborate about if that is occurring, if that is a concern for monetary policymakers, and what the Bank of Canada is doing in collaboration with its partners to mitigate that?
Sure. Yeah, I think in January, in January in our monetary policy report, we talked about divergent policies. And that was, of course, just after we saw the Federal Reserve have their first move to raise rates after a long period of time. So, I think globally, central banks and countries have been dealing with a very low growth environment. And so today we still have countries at various phases of recuperation and economic growth as a result. Now, what I didn't mention in my speech, but I think is something that we believe strongly in, is that lower oil prices is actually a good thing for global growth. Now, it's unambiguously not good for the Canadian economy, and we've seen that bear itself out with our GDP numbers last year. But we should begin to see, and we are beginning to see in some countries that are oil importers, whether it be India or others, some significant rotation and higher than expected growth numbers. So, the expectation of divergent monetary policy could continue. I think, we'll always see some ebb and flow. The numbers don't always kind of move in a straight line. And we will, in Canada, continue to focus our monetary policy decisions on meeting our primary mandate, which is to meet our inflation target, 2%.
Thank you. Good. I think we've got a question at the back. Do you have time for one more?
Yeah, sure.
Yeah, one of the factors that gets mentioned quite a bit is labor productivity, and how Canada's labor productivity is quite a bit less than other jurisdictions globally. When you look at your economic models, what are your assumptions around labor productivity as you look out, and how do you see government policy affecting labor productivity in Canada?
Okay, well, the really short answer to that is 2 weeks from today, we are going to announce our new estimate of potential output. So there'll be some really good work that the staff's done around Canada's potential. I mean, clearly there are parts of fiscal policy related to what we might see in infrastructure that can help with productivity, and it's just too early to know yet with what's been announced, what that's going to look like. But again, the staff and into our April decision will be analyzing that, and that will all be incorporated into our latest forecast. Certainly when we look at what our potential output will be. We're going to look at productivity and also potential from the standpoint of the labor market. So it'll be the combination of those two. So it's a great question, and I think you'll get a really great, thorough answer on April 13th.